Hey, welcome back to the show. Today, we're going to talk about how much fund managers actually make. I've ran a fund for the last 4.5 years. I have my entire family all runs and works in funds. So I've got a little bit of insider information here, but we're going to talk about how much money you can expect to make if you run a $200 million fund, a $20 billion fund. And you see guys in the news all the time, right? You see Ray Dalio taking home $2 billion from his fund.
In 1 year, right? Think about like the highest paid actor, hundreds of millions maybe, right? And then obviously fund managers, like tens of fund managers taking home billions of dollars.
It's wild. You see Ken Griffin shorting GameStop, screwing people like us, and still taking home fat stacks every year. We'll see if we bankrupt him though or whatever. But but this is gonna be a fun episode. So first thing I want to talk to you about is actually how fund managers' pay is split up. Now some of you guys might be like, Bridger, Lincoln, they just have a 2 and 20 model, right? It's just 2 and 20. That's the standard way. 2% management fee. They get 2% for just managing the fund, and then they get 20% of the performance or the carried interest. Yes, this is true. This is kind of common, but let's break out what that actually means. I'm going to use an example here. We got a timeline. We're going to use 0 to a 20% return that a fund has. I'll put a 10 right here as well. So a lot of funds will set up a benchmark to hit called a pref.
Also known as like a hurdle rate.
This is the preferential rate of return. These are all terms you can use when talking about funds. In my fund, it's 8%. And what this means is the first 8% of all returns goes directly to the limited partners, the investors. So if this year our fund did poorly, we only made a 7% return, I would actually not make any performance fees. All 7% would go to the investor.
What about this management fee?
Yeah, good question. So the management fee is taken right here at the beginning off the top at 2%. So yes, in that example, I still would have made my 2%. And the investors would have taken all 7%. But typically, fund managers aren't in this business to just make the 2%. They're in the business for the next piece, which is called carried interest. And we'll talk about that interest right here. So after the 8% in my fund, we do a 2% catch-up. Okay? So the 9th and 10th percentile go to the general partner or managing partners. It goes to us. So if this year we got a 10% return, first 8% would go to the investors, next 2% would come to us. Once we get above a 10% return, and this example was 20%, we split 80-20. 80% to the limited partners or investors, 20% to the general partner.
So obviously, you can charge whatever fee structure you want. Just the 2 and 20 is the most common.
Okay, so let's take some actual examples of how this looks if you were running a $200 million fund.
All right, so let's jump into the numbers, right? So assuming a 2% management fee, 2% of $200 million, $4 million. Not a bad paycheck, right? So $4 million right off the top goes to the general partnership, the managing entity of the fund, right? Now, let's assume a 20% return on investment, right? That this fund, whatever it is, real estate, hedge fund, venture capital, they achieved a 20% return that year. And let's assume also that they're paying annual distributions on that. So let's kind of do the numbers. So 20% on 200 million is 40 million in profits. But then we just talked about the 80-20 split between the LPs and the GPs. 20% of that 40 million is another $8 million. So just doing a little math, right? The 4 million from the management fee and then the $8 million from the performance fee gives this fund $12 million in pay that year, right? And obviously fund sizes differ a lot. Like if this is a hedge fund, a $200 million hedge fund, I mean, how many employees? I don't know, 10 to 20?
Depends, yeah.
It really depends. Not that many though. But on a real estate fund, depending on the asset.
If you're operating it might be a lot more people, right?
Yeah, but still, $12 million in profits, that's a pretty good paycheck to split up, right? But the reason that the fund model is so lucrative is when you do it at scale. All of these guys that you see on the top pay charts, like Ken Griffith and Jim Simons and all of these guys, right? Why they're making so much money is because they have so much money under management, right? So let's do this same scenario quickly, just with a $20 billion fund, right? So 2% management fee on $20 billion, that's $400 million. Assume a 20% return on that, that's now $4 billion, right, in performance. And then split up on the 80-20 between the general partner and limited partner is now $800 million in performance fees that the fund is taking. So again, just a little math here of the 400 and 800 puts you at $1.2 billion in take home for the general
direct
partnership.
to the general partnership. And again, you see a number of hedge funds less than maybe 300 people with 20 billion. I mean, that's not uncommon to see at a big hedge fund managing 20 billion. You'll even see bigger funds like KKR or Blackstone managing 200 billion. That's probably the next step. And you just add a zero, right, to all this. The beautiful thing about funds is the scalability, is the ability to scale with not a ton of overhead in some cases, but the dollars that you make are absolutely absurd of what is possible here.
Right?
Now, to make the deal even sweeter for fund managers, the IRS a number of years ago set out new tax code to incentivize fund managers. They wanted fund managers like us to take this risk to go and launch a fund to grab money from international investors, pull it together, and help invest it into economies, real estate, new businesses, whatever it is. And they gave fund managers an incredibly lucrative tax incentive. And down here we wrote carried interest loophole. So this right here, this is called carried interest. This is the performance fees on fund. This is why kids go to Stanford or Harvard for 3-5 years, and they hope and pray every night that they can make carried interest on a fund because for a few things. Number one, it's big dollar amounts, but number two, it's taxed at capital gains rates.
So just as a refresher, right? So ordinary income is taxed is 37% for the highest tiered income bracket, right? That's excluding kind of state, that's just federal taxes.
If you're in California, you're probably paying around 50% total if you're making that kind of money.
Yeah. Yep. So, and people hate taxes, especially the affluent, right? So 37% on ordinary income. Capital gains is taxed at either 15 or 20%. So that's like a 20% bonus, right? On top of any sort of money that you're making. So not the management fee. Management fees taxed at ordinary income. Once it's dispersed through all the partners of the fund.
Usually pays the rent and everything there. It's operating income, yeah.
But this is taxed as capital gains,
which is huge, right? And I hate the word loophole. I mean, it's a tax incentive. They've incentivized fund managers to do this, right? So you'll start to hear, if you start listening, CNBC, other news outlets, they'll talk about carried interest with fund managers, how they're making so much money and how it's terrible. But, that's how they wrote the tax code. Now, Donald Trump recently changed this for fund managers. I believe he upped it. It depends on the sector you're in. It depends if you're in venture or real estate, whatever you're doing. Upped it to 25%. And he changed long-term capital gains. You have to hold these investments for over 3 years to activate these long-term capital gains rates here. But that's the reason guys on the news, Donald Trump or Mitt Romney, don't want to share their tax returns. These guys have ran funds for a long time. They've been making carried interest money and been paying a lot less in taxes, especially if you're doing real estate. You can then depreciate the assets inside of your fund, and you're paying even less. It's crazy what you can do with a real estate fund, especially with taxes. It's pretty wild.
Yep. And if that's not enough, there's one other factor that we wanted to talk about of why these people are making so much money, right? Of why just these stupid amounts of dollars. And it's because they're actually pretty smart. So if you look at this graph on the screen, it's going to show you the top earners of 2020. It's specifically in hedge funds, right? All fund managers across different asset classes make a lot of money, right? But this is exclusively hedge funds. And it kind of separates the money they made from just the fund and then money they made from their own investments. Because we talk about that 80-20 split, right? So these guys will then, when you're making $1 million, a couple $1 million a year, you have a lot of excess money. And instead of going and just spending it all, a lot of them are very prudent and smart, right? And they'll go and take that money and put it into their fund as limited partners, right? So they're kind of a GP and an LP in the same fund. And then they're making that 80% instead of the 20.
So they make money in 3 ways. They make money through a management fee, they make money through carried interest, and they make money as an investor into their own funds. And typically they don't have to pay the other, because they're managing their own money, they typically don't even pay a management fee or carried interest to the general partner because they're also a general partner. They get an exclusion from that.
Yeah, so a lot of things going in your favor, but guys, let's be honest. Starting a fund is not easy. And being an excellent investor, being able to provide that 20% return every year, that is not easy, right? It takes a lot of skill, right? You need to be an expert. So I would say it's well earned.
I would say it's well earned as well, and especially in hedge funds. I mean, those guys are doing incredible things. It depends on different industries and sectors, but also we've seen a number of people in our groups and communities doing this. This isn't out of your scope or reach. I've ran a fund for about 4.5 years. We have a number of people that have ran funds or syndicates doing this right now that are regular people like me and you. And so that's why we kind of have this Wall Street Rebel movement. Like you can see our shirts and stuff. Below, we've got links and all sorts of training and stuff that we actually help teach people how funds work, how they run, the whole 9 yards, because this is the most lucrative game on the planet. And if you can figure it doesn't even matter. If you can figure it out in a year, great. If you can figure it out in 5 years, great. If you can figure it out in 15 years,
10, 20.
Great. Who cares, right? This is not a get rich quick scheme. This is get rich in the long run and get really rich by following one of the most lucrative vehicles on the planet. You can see why this is so amazing. And it's been amazing in my life. And my dad runs a fund. My brother is a fund lawyer and works at a number of funds. And it's a lot of money floating around. Funds are incredibly lucrative, and you can see why fund managers are taking the cake year after year. It's pretty impressive.